Hello everyone, we are from Group 16 and we will be presenting our findings for Korean stock market. In this report, stocks will be chosen in Korean Stock Exchange market. KRX, which is known as Korea Exchange, is the only marketplace where securities are traded there. We serve as the fund manager managing a client's portfolio of 100 million. Moreover, we will be creating two optimum portfolios by 30 out of 100 common stocks in Korean exchange for our client. The historical data in this report will be between 2018 to 2021. Our objective is to target large cap companies as most large cap companies are well established and often provide steady dividends. From this, we are veering more towards a conservative investment approach. We will be constructing two portfolios which are Portfolio A and B. Portfolio A will be constructed of the lowest possible risk with an expected return of 12%. So, this portfolio will be aiming for a lower and more steady growth rate. For Portfolio B, we will be maximizing the Sharpe ratio to find out the largest possible market premium at a given level of risk. For a higher return, clients will bear a higher risk and be compensated by additional risk taken. From the table above, we can see that the holding period of portfolio must be within 1 year with a total number of 30 stocks to be invested. To select the 30 stocks, we have chosen the stocks from Yahoo Finance which have big market cap and is considered to be safer or less risky to gain steady profits in the long run. Moving on, our client demands an annual return of 12% at the minimum risk for Portfolio A, while Portfolio B only focuses on finding the optimum portfolio among risky assets. Since we are taking stocks with large market cap, the level of risk would be as low as possible and the weightages are set to equal 1 more than or equal to 0. Lastly, we do not allow any short selling for both portfolios.
In this section, we'll be discussing on the construction of two portfolios with different sample stocks in order to meet the objectives and constraints that are set by your client. As you can see from the sample, we have taken the top 100 stocks with the biggest market capitalization from the Korean stock market. For Portfolio A, we have taken the total of 30 stocks that will give us a 12% return annually. In Portfolio B, however, we computed 30 stocks that will generate the highest possible return given the lowest degree of risk. Moving on, this section focuses on the methods chosen to form the portfolios. As you can see, both portfolios are following the same requirements that are set by our client, which is they must be large in market capitalization, low risk level, and both portfolios must contain 30 stocks each. However, the key differences between both portfolios are for Portfolio A, we use the solver to minimize the standard deviation to achieve the lowest risk possible, and Portfolio B will form by maximizing the Sharpe ratio to obtain the highest risk premium at the lowest risk possible. Both portfolios were selected by using the Markowitz portfolio selection method, and the stock samples were based on the historical data that we have computed from 1st January 2018 to 31st December 2020. We have taken 100 stocks from the Korean stock market, which were in the category of large market capitalization, ranges between 3 trillion Korean won to 450 trillion Korean won. By taking stocks with a large market cap, risk will considerably be lower as larger capitalization will provide a steadier growth and lower volatility level and able to withstand downturns without facing any bankruptcy compared to those stocks with medium to small market capitalization. We have then narrowed it down to 30 stocks from a sample of 100 stocks to meet the client's constraints in the portfolio. Therefore, Portfolio A and B will form. We have used the Markowitz portfolio selection method as a tool to select the stocks and assigning weightage simply because of the effectiveness of this method in identifying the optimal portfolio for risky assets and also to find the risk return opportunities that are available to us as an investor. According to Ravi Pati, this portfolio method is used to identify optimal portfolios which will minimize risk of a given level of expected return and also maximizes expected return for a given level of risk. To make both of the portfolios optimal, we use minimum standard deviation for Portfolio A, and for Portfolio B, we have used the maximum Sharpe ratio. In continuation, we have used solver to form portfolio A by minimizing the standard deviation so that the risk will be as low as possible. By performing a multi-stage filtering, we come up with a total of 30 stocks, which meet the constraints set by our client. The stocks were then weighted by lowering the standard deviation to a minimum value. For portfolio B, however, we have maximized the Sharpe ratio in order to obtain the highest risk premium at the lowest risk possible. We narrowed it down the sample of 100 stocks to 30 by assigning weightage to each stock and adjusted the Sharpe ratio to be at its maximum value.
Performance of portfolio A. We use the following formula in Excel to calculate the expected risk and the expected return formula to calculate the expected return of the portfolio. For actual return, we use historical data from January 2021 to January 2022 to calculate the return, and as a result, our portfolio realized return was 12.67%, which is higher than our expected return, which is 12%. The following table also shows that the portfolio's actual risk is lower than our expected risk. The following table shows the comparison between the actual price and the expected price of the stocks in the portfolio. We calculated the expected price using the stock data return for the past 3 years, as we expect the stock price will grow at a similar rate. However, 22 out of 30 stocks in the portfolio had their price drop during the holding period and is lower than the expected price. To explain the phenomenon, it is revealed that majority of the Korean firm's stock returns were negatively affected by the second wave of the COVID-19 pandemic. As most of the stocks in the portfolio is underperforming, it would be strange for our portfolio to yield a negative return. However, as shown before, portfolio A has outperformed its expected return with a 12.67% return. So, to explain the above, we discovered that the stock Meritz Financial Group Incorporated has performed extremely well in the portfolio despite the economic condition. From Meritz Financial Group Incorporated income statement, you can see that the company's net profit has been growing outstandingly even during the pandemic, which makes it one of the few firms that exhibited outstanding growth during the pandemic. This caused in a 358% increase in their stock price and also exceed our expected price by 359%. As a result, by buying 607 number of shares in the Meritz Financial Group Incorporated stock, portfolio A managed to gain a 20.73% return from the stock alone. For the performance of portfolio B, in the table, we can see that portfolio B did not meet its expected return of 25.4%, but also incurred a negative return of 23.48%. However, the table shows that the portfolio B's actual risk is lower than the expected risk. Now, as for the Sharpe ratio, portfolio B has a negative Sharpe ratio, which means that the risk-free rate is greater than the portfolio return. By changing our objective to maximize the Sharpe ratio with the same sample of large cap companies as portfolio A, most of the stocks in the portfolio B is still the same with portfolio A. The difference between portfolio B and portfolio A is only Samsung Heavy Industries Co. replacing KT&G Corporation in portfolio B. Just like most of the stocks, Samsung Heavy Industries Co.'s stock price has dropped significantly, which resulted in a negative 34.52% difference from its expected price. The Korea Composite Stock Price Index (KOSPI) has an annual return of negative 10.55%, variance of 0.0239, standard deviation of 0.1546, and a negative 0.74 Sharpe ratio during the holding period. It's not surprising, as the study by Pyo 2021 has demonstrated that the pandemic has caused a high stock return volatility on the KOSPI index due to government policies and measures against the pandemic, therefore increasing the risk of the stock market index. From the comparison between the Korea Composite Stock Price Index and portfolio A and B, the KOSPI index has a higher variance and standard deviation than both portfolio A and B, meaning it has a higher risk than both of the portfolios. The comparison also shows that portfolio A performs better than the Korea Composite Stock Price Index with a positive yield of 12.67% compared to the stock index, which has a negative return of 10.55%. However, portfolio B performance is even worse off than the KOSPI index with a negative return of 23% compared to the negative return of 10.55%. As we aim to maximize the Sharpe ratio, we took more risk by assigning more weightage to the riskier assets in portfolio B compared to portfolio A, which explains why it has a huge difference compared to portfolio A.
In conclusion, portfolio A is overperformed as the actual portfolio return is higher than the expected return by a difference of 0.6%. On the other side, portfolio B is underperformed when we compare the actual portfolio return of negative 23% and the expected return of 25%. From the result, we suggest our client to keep portfolio A and liquidate B. Last but not least, our suggestion for improvement is through international diversification. This means that having more than 300 stocks from different countries, industries, and correlation. For example, Marius gave us a 20% portfolio return, and through the international diversification, we believe that we can have more opportunity to include more stocks like this. That's all from us, and thank you all for listening.